Hello and welcome to the first show of 2025 with myself, Josh Mahony, Chief Market Analyst at Scope Markets. This is the Movers and Shakers show where we look at the previous month. We want to see the big movers across the likes of the indices, the FX and the commodity space and try to ascertain whether those moves are going to continue or whether they're going to reverse. So let's get into it. So first and foremost, we're going to be taking a look at the breakdown for the big performers in the indices space. And you can see here, it's the Japanese market that has outperformed. The Nikkei 225 up 2.79% over the course of the month. Now, we might attribute that to the moves in the FX markets, which of course have seen the likes of dollar yen moving towards the upside. We're going to quickly look at the 225, but just on the bottom end of this scale, we also want to look at the big underperformer, and that's a Russell 2000. If you cast your mind back to November, and when we did this a month ago, Russell 2000 was at the top of the pack, gaining over 10%. Well, now it's at the bottom, and at the time, we were talking about a big resistance level and the potential for a pullback. That's exactly what we have seen, but this could create the basis for a fresh buying opportunity. So let's look at the chart for the Nikkei 225 first and foremost. This is the daily time frame. I'm just going to put my head in the corner. And so what you can see here is that essentially we're tracking, for the most part, the moves in dollar yen. So here is dollar yen overlaid with the Nikkei 225. So as you can see here, the gains that we've been seeing for the dollar yen pair have also come hand in hand with the upside for the Nikkei 225. Of course, this stands to reason that essentially if you're looking at a devaluation of their currency, then you're also looking at the stocks essentially benefiting from being more competitive on an international basis. Now, it's notable that this hasn't necessarily been moving in lockstep. So as we can see here, the gains for Nikkei 225 sometimes coming ahead of that upside for dollar yen. The pullback that we're seeing here came after we'd seen a pullback for the Nikkei 225. So in actual fact, it does feel like the stocks are almost leading the FX pair rather than the opposite way round. Nonetheless, the gains that we've seen for dollar yen provide the basis for gains for the Nikkei 225, and that's potentially part of the reason why we're seeing such strength for the Nikkei 225 over the course of a period where, by and large, the sort of Santa rally lasted for all of about 3 days, and then it faltered at the back end of the month for US markets, where that hasn't necessarily happened over in Japan, where we have seen strength. Nonetheless, if you look at those gains, we're seeing upside on the bottom end, but not necessarily a huge amount on the top end. So the bottom end, we're sort of creating higher lows, right? But on the top end, we're pretty much flat here at the moment. So it's a sort of rising wedge formation that we're trading within at the moment. The question mark is, do we break towards the upside from here? And you can see we have seen that tentative move. Let's get an actual horizontal one so we can know what we're dealing with here. So essentially you're looking at a potential breakout with a move through 40281. It's notable that we pulled back here on the 30th, consolidating, starting to move higher once again as we kick off the new month. So that looks like a likely retracement before we head higher. There's of course a question mark over whether we could pull back further, and that is a possibility. But essentially, unless we break the 38200 support level, this current pullback looks like an opportunity for the bulls once again. In terms of the fibs, we're probably midway point, so it's maybe a 50%, or I think that is. So let's look here. Yeah, so we've gone past the 50%. We're not at the 61.8. So, you know, we're in a sort of mid-range here. We could bottom out here and push upwards from here. But we could also see another pullback into support. The key to it is whether we see dollar yen rolling over at some point. I wouldn't necessarily be that surprised. I don't think that this dollar yen rally is going to last forever. And, you know, there's arguments that we're going to actually see the Bank of Japan hike rates soon enough. So, you know, why are we seeing such massive devaluation? largely off the back of a slower easing timeline from the Federal Reserve, but it's not necessarily a reversal of that. And there's some arguments essentially to say that it's overdone somewhat. The Federal Reserve pointed towards 2 rate cuts this year, while markets are currently pricing 1. So have we gone a little bit far on that side? In any case, we pull back, whether we bottom out here and rally or whether we come into a deeper retracement and rally, that remains to be seen. But certainly as things stand, I do think that the pullback that we're seeing at the moment offers likely an opportunity for the bulls once again, considering the trend that we have got in play at the moment. But it probably makes more sense to be looking for a move back up to the 40281 rather than resting on your laurels and saying we're definitely going to break towards the upside. Then, like I said, we had the Nikkei, the Russell 2000, and the Russell 2000 is here. And what we can see here is this pullback, right? So when we recorded this last time around, remember we were pretty much at that resistance level. So we recorded it here, right? And so I remember talking about this and saying, look, we've got this massive resistance, 2458, established back here in November 2021. And we just sort of got very far away from things. It doesn't necessarily mean that the bullish trend is over per se from a wider perspective, but certainly when you see moves that look like this, right, and it sort of run quite heavily away from where the sort of base end of that trend is, at some point you're likely to come back into either that bottom sort of trend line that joins up the lows, or this area which is sort of grabbing some of the retracements as well, right? So this sort of medium retracement, these are the deeper the retracements. We've come back towards that ascending trend line. Of course, we don't have 3 touches here, so it's not a confirmed trend line. But what it does is show you the sort of route of travel for the bottom end of this trend and point towards an area where we could see the bulls coming back into play once again and potential for support to hold up. So from a fib perspective, where do we stand? Once again, we're in the midpoint here. So you're looking around the 50% mark. And so some people might just look to take this and say, well, I could take a trade here and put my stops below this low and take my profit at the high. And essentially you've got a 50-50, but you're banking on this trend and for it to not roll over. Now, the argument for weakness in the Russell 2000 and the moves that we have been seeing of late is associated with that view that we're going to see rate cuts at a slower pace from the Federal Reserve. Of course, this is an index that is highly reliant on leverage, on borrowing. Many of the companies within the Russell 2000 are not profitable, and therefore the cost of borrowing is a key determinant of whether these businesses are going to be able to move into profitability or not. And then if they're not, then they might have to take on more debt. They might have to issue more shares. So, of course, with higher interest rates or a slower pace of easing comes weakness for the Russell 2000. Like I said, I think there's a good chance that we do see some question marks around that current pricing. At the moment, it's for a single rate cut for the year. Are we going to move to 0 rate cuts, or are we going to move to a view of 2 rate cuts? I think there's more of a chance that we move towards 2 rate cuts, and in which case, that could be beneficial for the Russell 2000. But in any case, let's see how things are playing out over the near term, bearing in mind we could still come into this trendline support in the 61.8, or we could bottom out here. So the 4-hour chart, so we've seen this sharp decline coming into play. We saw that pop pre-Christmas, the drop post-Christmas, similar to what we're seeing in pretty much all of the major US markets at the moment. And we're sort of up above that prior support level or prior low of 2194. So a break below that level, I don't think is necessarily going to give way to sharp declines, because we've got this area with sort of trend line, the 61.8 support. So we could see a move in towards that area, but if we don't, the key thing we want to be watching out for here is a move through 2281. That would complete a double bottom formation and point towards a possibility that this is the end of that selling pressure for the Russell 2000. Like I said, there is still risk at the moment because this near-term trend is very bearish, sort of shallow retracement, and then looking to sell off once again. But if we don't see that break below support, and if we move up through 2281, I think there's a good chance that we do see that wider bullish trend start to kick in once again for the Russell 2000. So going back to the performance for some of these different markets, we can see here within the FX markets, it's the US dollar that's really seen strength. And a lot of that has, like I said, been attributed to the Federal Reserve, the outlook for rate cuts in comparison to some of these other central banks. Notably, the New Zealand dollar finds itself at the bottom of the pack for a second month running. This is something that a month ago I was talking about once again, because the top was the dollar, the low was the New Zealand dollar, and I was talking about the possibility of extension towards the downside and a continuation of this weakness. That's exactly what has played out. And the question mark is whether we're going to see more of the same, really, because when you're talking about the possibility of further sort of downgrades in terms of expectations for the Federal Reserve's easing over the course of the next year, you know, like I said, I don't necessarily think there's a huge amount more that's going to happen on that front. A lot of it, I think, is going to come, you know, once we see Donald Trump coming into power, once we see his new policies, once we see things changing on the inflation front, whether it is an uptick in inflation or whether it turns out it's not as much of a problem, which is the camp that I'm in personally, bearing in mind that Donald Trump is likely to enact policies that could bring goods-based inflation. Goods inflation is pretty much non-existent at the moment. It's services that's the problem. And I don't think he's going to lift services inflation personally. Nonetheless, I want to jump into the chart for the New Zealand dollar against the US dollar. So here is the chart for Kiwi against the greenback. And like I said, you know, we can look back to where we were a month ago and say, you know, quite clearly the last month was pretty dour for bulls, but really, really good for those that remained short this market. Now, I've overlaid the New Zealand 2-year yield and the US 2-year yield. Essentially, this is a view on where people think interest rates are going to be moving over the near term. And there's a clear move over the course of recent months towards greater rate cuts from the New Zealand central bank, or the RBNZ, compared to the Federal Reserve. Are we going to see more of the same? I think there's a good chance that we do. I mean, ultimately, you know, this is something that you could very easily overlay yourself to see whether we start to see divergence. And if we start to see an uptick in terms of that sort of, whatever you call that line, purple line, then that could form the basis of things starting to settle somewhat. You know, from a wider perspective, we can see here that we have got this key support level coming into view down below, which is at 0.55118. So that's the next support level. Between here and there, we basically don't have anything. So there's a good chance we do see further downside. You can see here, sharp decline, consolidation that we've seen here with the breakdown through support. This rally at the moment, therefore, looks like an opportunity for the bears to reload once again. We've come into the 50%. That's a lot of that today that we're talking about, and starting to roll over. So if we break the 56646 level, then yeah, we could start to portray a bit more of a bullish outlook. But until that happens, this market clearly has been very consistent, and this is the name of the game when it comes to this video series that I do every month, right? Essentially, you want to be short the right markets, long the right markets. Sometimes people just bury their head in the sand and just say that they just want to trade one thing. That can work for some people, but for other people, they want to try and find the right market, right? This is the past few months, and this is a great market to trade, right? So if I'm talking to you about this every month, then, you know, that's beneficial for you guys to be able to get a view on a market that has been very consistent in its trend. And so I think what is underrated within trading is the ability to choose the right market. It's not just a case of having this incredible strategy that somehow manages to make every single market condition profitable. Instead, you find the right market condition and you can apply relatively basic strategies when it comes to technical analysis to take advantage of that. On this occasion, we've seen a breakdown following consolidation, very clear downtrend in play. We've popped a little bit. We could rally a little bit more into this deeper retracement zone. That still, of course, is a possibility. But essentially, whether we decline from here, whether we retrace a bit more, I think this zone is a retracement zone before we see the bears coming back into play, unless that 56646 level gets taken out, and in which case I'd say, okay, let's see how this plays out. It doesn't mean I'm necessarily bullish straight away, just a little bit more cautious to see exactly how things shape up. And finally, the commodity space is looking like this. Nat gas once again taking a top spot. Nat gas is like top or bottom every single month, and that's because we've seen such massive devaluation that it's got to the point where some of the moves that we're seeing can provide huge percentage term swings. Sometimes I'll talk about it, sometimes I won't, because I don't want to just be talking about nat gas every month. Palladium on the bottom end. Palladium has also been seeing some really significant moves over recent months. A lot of that's tied up to China, and also this perception that it might be sort of oversold. It's been hit hard, to say the least, over the last year and a bit. So firstly, let's jump into nat gas. I think this is really interesting because there's a tie-up between Russia and Europe that has come to a halt now. So quite whether Europe is well prepared to be able to go on its own 2 feet forevermore, that remains to be seen. But certainly that points towards the potential for further tightness to come into play. So this is the wider time frame. So this is where the whole Russia-Ukraine thing really kicked off, and Europe was struggling in a big way to be able to try and find the gas to make up for that breakdown in relations with Russia. Now, bear in mind that we're, of course, talking about Donald Trump. He says that he's going to end the war with Ukraine overnight. Of course, that's probably not going to happen, but nonetheless, you have to be aware of that. If we saw a deal made that could potentially reopen the floodgates when it comes to gas coming into Europe, and even, not even that, but the deal coming into play, people could then start to think down the line we might see a deal where Russian gas starts coming back into Europe in a meaningful manner. If that happens, that would likely drive down prices once again, because supply is easier. Supply is not a problem. But at the moment, supply could be a problem because of what's happening over in Europe versus Russia and that deal running out. You've also got this question mark about, is this year going to be a year that's going to be dominated by economic growth and higher spending and higher consumption? That should be good for gas prices. So there is the potential basis for this to have bottomed out. And certainly if we look from a long-term perspective, we're at levels that are sort of relatively justified even prior to this crisis. Now, if we look back here at the daily time frame, what we can see here is that it's a relatively clear-cut bullish trend that we're playing out here. So the creation of higher highs, higher lows. We're seeing this sharp pullback here where we closed out the year. So this big jump and rally here on the 30th, then on the 31st, we reversed that. But if we look at the 4-hour chart, this looks like a potential opportunity for the bulls, really, because we've seen this sort of rally, consolidation, sort of wedge formation, the gap higher and sharp rally, and then the sharp pullback. But you'd likely believe that this sharp rally and gap has a basis in something that could once again provide strength for prices here. So if we get the fib, this looks like a 76.4 to me, and yeah, straight on the nose. That's an absolutely perfect 76.4 fib retracement that we're seeing at the moment, and respecting it as things stand, we're now up more like the 61.8. So essentially what we're looking for here is the potential for the bulls to come back into play once again. You can say, oh, it's the best performing asset out of the ones that I've mentioned. But in actual fact, that's despite this sharp pullback that we've seen at the back end of the month. We've very easily, got the opportunity to potentially move all the way back up to that prior high, which is another 14% higher from here. So I do think there's a good chance that we do see the bulls in play here. Of course, there's got to be a what if, caveat to it. And that would be, of course, this swing low that I've drawn on here, which is 3.234. A break below that level negates this intraday trend. And then we start looking at things on a wider perspective. And then you could start saying, well, we've got this sort of longer sort of perspective here, sort of clipping up the lows. And so that retracement that we're seeing at the moment, maybe we start looking in towards this kind of area, 3.2, potentially down to trendline support. So that's the what if, but that's only if we break the 3234 level, which at the moment, you know, we've tagged that 76.4. We're perfectly respecting it, and we're starting to move higher once again. So I think the bulls do start to look like they're coming back into play once again. And Palladium, of course, it's been hit hard over recent years on the back of this move towards EVs and the destruction of demand around the catalytic converter industry. But, you know, there's been signs that we could be bottoming out here, or at least ending that trend, right? So we've seen, you know, months where it's been a big outperformer, months where it's been an underperformer. It feels like we're sort of stuck within a range, potentially bottoming, because of course we did break up through that swing high of 1108 and pop up into the 1250 kind of area, 1245. But now we've reversed much of that. So I would say if we're looking here, I would say that the risk is more that we see the bulls coming back into play, because if we're looking for shorts, the gains towards the downside are relatively minimal. Whereas the upside, if we get back up to where we were recently, you know, that is much more substantial. The daily time frame does still show you that a bearish trend remains in play, because as we see here, we've got this, we can clip up these swing highs, and you can see here that they still remain on a bearish tilt. And on the bottom end, we've got the similar kind of thing, right? We're seeing lower lows, the latest with a move through that 895, and we came into 889. So the bears do still remain in charge, but if we break up through the 952, then we can start to look at this in a more positive light. So near term, yes, we could still see some downside, but as we come closer and closer towards this zone of prior lows, so I think there's a greater chance that the bulls are going to come back into play. And certainly given that rally that we did see in October heading into November, that points towards the possibility of the bulls coming back into play before too long. But this isn't one that right now I'm saying I'm bullish or I'm bearish, because certainly from a wider perspective, the trend is not a friendly one. But I wouldn't necessarily say that I'm super bearish right now either, because there's a good chance that this forms a sort of basing pattern, and we've come close enough towards the bottom end that, you know, we could bottom here, we could bottom down at the 830 level. But either way, I think unless we break through that 830 and really start to gather momentum towards the downside once again, you know, this consolidation that we've seen pretty much throughout the entirety of the last year does still hold. And the lows that we're seeing at the moment that have taken a good couple of months to take us down towards it do provide the basis for a potential pop before long. That's all for today. I hope it's been useful for you guys. Like I said, the key thing here is talking about the ability to find markets, right? You might want to find, as we do here, that the best performing and worst performing over the past month, or you might do it for the past day or the past week or things like that, right? And this ability to be able to sort of look into what the big moves are at any point in time and the big trends, that can give you a leg up on some of the other traders out there that may not necessarily take the time to be able to look at the wider environment that's in play at that time. Other than that, of course, it's a new year, so happy new year to everyone, and hopefully you guys have had a good break and feeling refreshed for the new year ahead. And certainly we're going to be producing plenty of content over the course of this new year, so make sure to follow, like, subscribe, and watch out for plenty of content as we try to decipher a year that's going to be a big one. Quite frankly, I worked this same kind of job, right, throughout Donald Trump's previous reign, and yeah, it was an interesting one. A lot of talks about trade wars on a daily basis, so we're probably going to be seeing a similar kind of thing playing out over the year ahead.